Welcome, and thank you for joining this session today. My name is Marcus Rutherford, and I've been with Yardi Systems for 6 years. Currently, I am a senior corporate trainer on the corporate training team. Today, we are going to cover some basic accounting concepts which will help you understand a bit about what your software and your accountant is telling you about your business. At the end of the presentation, I will provide you with an email address in case you have any questions. Now that you've gotten involved in real estate and property management, do you ever find yourself wishing you had paid closer attention in accounting class? Although property management ultimately deals with people and where they live, or a space that a business occupies, at its core, it's simply accounting. Let's talk a little bit about the accounting system that the world uses today. It's called double entry accounting, and it was first developed back in the 15th century by a friend of Leonardo da Vinci named Luca. It's clearly a good system if that's what we're using today. For centuries, everything has been recorded manually into books. It's only recently that we've moved to computer softwares from something as simple as Microsoft Excel up to a dedicated property management accounting system. Even though computers are doing the work, I feel you will still benefit by understanding a bit of what's going on behind the scene. It can seem complicated, but don't worry. Today, I'll guide you through the 5 key accounting concepts that are the baseline for all accounting tasks that are required to run your business. Let's get started. As I mentioned, there are 5 key concepts you'll need to understand to become a master of double entry accounting. Number 1, the chart of accounts. This is really just a list of your categorized accounts together in one place. It provides a bird's eye view of each account that spends or makes money. Debits and credits. These are the amounts of money that are tracked going into or out of your accounts. Things like rent payments or maintenance costs. The accounting equation. The accounting equation builds on our first 2 concepts. It is used to display the health of the company through a balance sheet or income statement. Number 4, financial statements. These summarize important accounting information, and there are 3 main types that we'll go into a little later in the presentation. And number 5, accounting methods. These are the 2 different ways to organize your accounts, cash and accrual. You'll need to choose one, and we'll talk about what the differences are. First up, the chart of accounts. This is an organized list of categories to track a company's financial activities. This list covers all of the financial accounts in your general ledger and provides organized insight on the financial health of your company. It is really just a way for you to see all the transactions that took place organized so that you can tell what effect those transactions had overall. The chart of account is divided into sections. Each section has heading accounts at the beginning and a total account at the end. Between the heading and the total, there are several regular accounts. Regular accounts hold funds, while header and total accounts organize the chart of account into sections. Accounts are listed based on when they reflect in the financial statements. We will start first with our assets. Then we'll add liabilities. Then equity is listed, followed by income, also known as revenue, and lastly, expenses. The specific chart of account is going to be different for every company because each company is unique in the types of sub-accounts they use to maintain and track. As I mentioned, the chart of accounts are listed based on where they reflect on a company's financial statements. So while you can name or number your accounts in any way you wish, and your specific sub-accounts will be specific to your company, you should still keep them ordered in a standardized way using globally accepted accounting practices. This ensures consistency between financial statements for every company. This is a requirement for publicly traded businesses by law. We'll get into some of the account types in just a moment. The chart of account looks like a big, complicated list, but if you're using an accounting software rather than something basic like Excel, then you should be able to drill down into the items in your chart of accounts and gain more details and insight. Let's dive a little deeper into the different types of accounts that you might see within each section of your chart of account. First up is our assets. Assets are going to be things that we own. For example, your operating cash account, land, property, vehicles, and lastly, accounts receivable. Accounts receivable is the GL account that is used to track how much money is owed to you. Next up, liabilities. These are going to be things that you owe. For example, mortgage, loans, security deposits, prepayments, and accounts payable. Accounts payable is the GL account that is used to track how much money you or your property management company owes to others. Next is equity. This is going to show your shareholders' stake in the company. You'll also find accounts like retained earnings, as well as your owner's distribution and contribution. This is generally the smallest section of the chart of account. Next up is income. Incomes are going to be fees that are charged. So for example, rent, pet fees, garage or storage fees, application fees, damages, and lastly, late fees. The last section of the chart of account, as I mentioned before, is expenses. These are going to be items that are paid. So for example, bank fees or interest, supplies, landscaping, pool maintenance, or insurance. As I mentioned before, each chart of account is going to be different for every business because it depends on the sub-accounts that are being used to track. Concept 2, debits and credits. Each section of the chart of account has a set normal balance. The two options for the normal balance are debit or credit normal balance. For each section of the chart of account with a normal balance of debit, the account will increase when debited and decrease when credited. For the sections in the chart of account with a normal balance of credit, the account balance will increase when credited and decrease when debited. So you may be wondering, what are the set normal balances for each section of the chart of account? Let's move forward and find out. Assets and expenses are the only two sections of the chart of account that have a normal balance of debit, meaning when we debit an asset or expense account, it increases. The remaining sections, liability, equity, and income, all have a normal balance of credit, meaning when we credit those accounts, they will increase. Since the normal balance determines when an account increases, if you ever wanted to decrease an account, you would simply do the opposite. A good humorous way to remember each section's normal balance is to think of it as a sandwich. And when it comes to sandwiches, accountants prefer credit sandwiches on a debit bun. Remember Leonardo's friend Luca and his double entry accounting system? Well, the whole reason behind why we call it double entry accounting is because it's built on the concept that every financial transaction has at least two sides to it. Think about it. If you bought a hamburger, two things happen. You reduce the amount of money in your pocket and you get a hamburger. Well, in the property management world, if a tenant pays you rent, you increase the amount of cash you have in your bank and decrease the amount of money your tenant owes you. The two sides are always in balance, and your debits must always equal your credits. Concept 3, the accounting equations. The accounting equations, which are considered to be the foundation of the double entry accounting system. The two accounting equations shown on the screen are how your equity and profit are calculated. Assets, remember the things of value that you own, minus liabilities, what you owe to someone else, equals your equity. Your equity will show on the balance sheet report. So equity is the difference between the company's assets and liabilities. However, this is a little different than profit, which is often called net income. The way you figure out net income is income, which is the whole point of why you're in the business, all the money that's coming in, minus the expenses, what it costs you to run your business, equals your net profit, which could be negative, which we hope is not the case. As I mentioned before, your equity will reflect on a balance sheet report and your profit will show on an income statement. We'll discuss those two reports more next. A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time. The balance sheet is based on the fundamental equation of assets equals liability plus equity. Each GL account appearing on the balance sheet maintains its balance at the beginning of each year. Some examples of accounts that may appear on a balance sheet is your operating cash account, which is your real-world bank account, accounts receivable, as well as security deposits. The income statement shows income and expenses for a certain time frame. For instance, if you want to review your income statement, you can choose to do so over a quarter or a full financial year, or even customize the time frame you would like to view it. After your business year is over, the income statement will refresh, meaning it goes back to zero to start the new accounting period. The income statement will show you accounts like rent or storage income and expense accounts like landscaping or pool maintenance. The balance sheet and the income statement are related and also used alongside with the cash flow statement to provide a snapshot of your company's overall financial soundness. Pulling these reports together provides a picture of how your business is doing from various perspectives. As I mentioned earlier, the balance sheet looks at your assets, your liabilities, and equity accounts. The balance sheet really illustrates your business's net worth at a particular point in time. It can also give interested parties, like banks when applying for a loan, a snapshot of what your company currently owns and owes. The income statement combines revenue and expense data to display the company's overall profitability. Essentially, revenue is used to pay all expenses that are owed. So you're tracking your business financials activities in all of these accounts, but when do you recognize revenue and expenses? This is where our final concept, cash versus accrual, comes in. I've had the opportunity to help companies set up their property management systems, and one of the first questions we ask is, what is your accounting basis? Most people don't know the answer, but it's quite simple. It all comes down to when you want to count or recognize when you make money or spend money. There are only two options. Our first option is accrual accounting. Accrual accounting recognizes income when a charge is created and expenses when entered. For example, if you are using the accrual accounting method, and let's say you charge a resident for rent, income is instantly recognized, although the tenant has not actually paid their rent. On the expense side, when you receive an invoice from a vendor and enter it into your accounting software, the expense is recorded, although you haven't paid for the goods or services. Since accrual accounting is tracking income and expenses as they're being entered, it requires an AR account to track how much money is still owed to you and an AP account to track how much you or your property management company owes. The next option is cash accounting. Cash accounting only recognizes income when it is received and expenses when it is paid. If we stick with our same example of charging a resident rent, with cash accounting, we are not recognizing income until the payment is received from the tenant. And on the expense from a vendor providing goods or services will not be recognized until we make a payment. Since cash accounting doesn't track income and expenses when entered, there is not a need to track what is owed or what you or your property management company owes. An easy way to think about cash accounting is that there is never an impact until money has exchanged hands. Cash versus accrual. Which one is better for you? There are pros and cons to each, but Uncle Sam says you must pick one and stick with it. A key advantage of the cash method is its simplicity. It only accounts for cash paid or received. Meanwhile, a key advantage of the accrual method is that it includes accounts receivable and accounts payable, which gives a more accurate picture of the profitability of a company. Remember, financial statements are snapshots in time, and it's important to understand the effect accounting basics has when you or other financial institutions are interpreting numbers. Next, we will review some scenario-based examples and learn about the accounting impact on both cash and accrual methods. Our first scenario is it's the first of the month and we tell a resident she owes us $1,000 for rent. We'll start off on the accrual side. The two accounts that are impacted when we tell a resident that she owes us $1,000 is going to be the AR, accounts receivable, and our rent income account. Both of those balances will increase. In order for us to increase our AR account, which falls under our asset section of our chart of account, we must debit it. In order for us to increase our income account that falls under our income section of our chart of account with a normal balance of credit, we would credit it. In this scenario, debits are still equaling to credits. The two reports on accrual accounting that will be impacted with this is the balance sheet as well as the income statement. Next up is the cash accounting impact. As you can see on the screen, there is no accounting impact for cash method. Remember, until money has exchanged hands, there's never an accounting impact. Our next scenario is that resident pays you $1,000 for her monthly rent. On the accrual side, the two GL accounts that are impacted is accounts receivable and your operating cash account. Accounts receivable is now going to decrease because now less money is owed to you since the resident has made a payment. Your cash account, which is your real world bank account, will now increase because you've received money from your tenant. In order to decrease my AR account, I would credit it. In order to increase my cash account, I will need to debit it. On the accrual accounting method, the only report that is impacted when receiving a payment is the balance sheet. Let's go over to our cash accounting method. Now that we've received the payment from our tenant, the two GL accounts that are impacted on cash accounting is your income account as well as your cash account. Both of these accounts will increase, so we'll need to credit our income account and debit our cash account. If we ran reports to see this accounting impact, it will reflect on our income statement as well as our balance sheet. Our next scenario is that our community pool is dirty. We hire a company to clean it, which will cost $250. On the accrual side, the two accounts that are impacted with this transaction would be our accounts payable as well as our expense account. Accounts payable will be increasing because we now owe money to a vendor, and our expense account will also increase because we are now recognizing that expense. In order for me to increase my AP account, which falls under my liabilities, I would credit it. And in order for me to increase my expense account, I would debit it. If I ran reports to see this accounting impact, I can see it on my balance sheet as well as my income statement. As I mentioned before, for the cash accounting method, there's no accounting impact until we have actually made our payment. Our last scenario is after they have cleaned the pool, we pay the pool company $250 for their services. On the accrual side, the two accounts that are impacted is the accounts payable as well as your cash account. Both of these accounts will be decreasing. Accounts payable is decreasing because we now owe less money to one of our vendors, and our cash account is also decreasing because we made a payment. In order for me to decrease my accounts payable account, I would need to debit it. And in order for me to decrease my cash account, I will need to credit it. This accounting impact will reflect on the balance sheet. On the cash accounting side, my two GL accounts that are impacted is my expense as well as my cash account. I'm now recognizing my expense, so I'll need to increase that account, and my cash account is decreasing because I've made a payment. In order for me to increase my expense account, I'll need to debit it, and in order for me to decrease my cash account, I will need to credit it. The two reports that this accounting impact can be seen on is the income statement as well as the balance sheet. As I mentioned in the beginning of our session today, there are 5 key concepts you'll need to understand to become the master of double entry accounting. The first one was the chart of accounts, which is really just a list of your categorized accounts together in one place. It provides a bird's eye view of each account that spends or makes money. Debits and credits. These are the amounts of money that are tracked going into or out of your accounts. Things like rent payments and maintenance costs. The accounting equation. The accounting equation builds on our first 2 concepts, and it is used to display the health of a company through the balance sheet or income statement. Financial statements. These summarize important accounting information. And lastly, accounting methods. Remember, you have 2 options, cash or accrual. This ultimately depends on when you or your property management company recognizes income and expense. And as a reminder, pick one and stick to it. I hope you took away some useful information. If you have any questions, please reach out using the email address you see on the screen, and we'll get right back to you.